Thank you, everybody, so much for joining us today. My name is Caroline Scannell. I head up brand development here at Paperchase. If you don't already know us, we are restaurant accountants. We've been specialized in restaurant finance for over 30 years, helping restaurants of all shapes and sizes across the United States, United Kingdom, and Middle East help optimize their business and especially help them grow and expand. So we're super excited to bring you our latest webinar topic for you all today, which is about taking the next step for your hospitality business. So I've got Simon Binder here, who's our chairman at Paperchase, and I've got Dimitri, who runs our corporate finance division. They're going to be walking you through the steps of expanding your restaurant, especially if you have a restaurant that's already doing really well, and you're looking at what does the next, move look like for me. Before we get started, just a couple of housekeeping tips. If you have any burning questions during the webinar, you can go ahead and leave them in the chat, but we'd prefer that you keep them till the Q&A at the end, when we'll be able to answer any questions that you have. Even if they especially are specific to your restaurant, we'd be happy to answer them. And then, so let's get started. I'd like to introduce Dimitri and Simon.
Thank you, Caroline, and thank you to everyone that has joined the call. My name is Dimitri Khrushchev, and if you happen to notice an accent during this webinar, I grew up in Johannesburg, South Africa. And if you're wondering why a South African would be called Dimitri, it's because I'm originally from Bulgaria. I moved to America on a tennis scholarship at Cal Poly in San Luis Obispo, California, roughly about 16 years ago now. And upon graduating, I started my career in finance as an equity research analyst. My hospitality finance career began about 6 years ago at Triple Enterprises, now acquired by Paperchase almost 2 years ago. At Triple Enterprises, I really worked in corporate finance roles, much like I do now at Paperchase. So what we would do is really help clients with M&A advisory, both on the buy side and the sell side, fundraising advisory, particularly on debt financing and growth equity capital. And we also provided fractional CFO services and FP&A services to our clients on a recurring basis. I specifically joined Paperchase about a year ago, and I've been helping build out our corporate finance division with Philip Gay, out of our LA office, but we are also working with our New York office, and I'm currently in London, visiting at our London office. We've been working with our clients to prepare board level presentations, investor materials, and fundraising and M&A materials. So we've been working hard at providing that value across our client base all over the world. Having said all that, I'll now hand it over to Simon for his intro.
Hi, everyone. Likewise from me, big thanks for joining us. My name is Simon Binder, and I'm the chairman of Paperchase. But my background is, unlike most of the people at Paperchase, my background is restaurants, not accountancy. So over the years, I've owned and opened quite a lot of restaurants, and I've been firsthand at having to raise finance for them. So I thought I might be able to kind of offer you some of my war stories and some of the experiences I've had. So let's get into it. What we're going to go over today is we're going to go over sort of how we kind of get started. So every restaurant is a bit different, as we know, but we've tried to kind of narrow in so that we can at least have something to speak about. If we sort of miss something that is obvious for your particular restaurant, then let's save that for the Q&A, and we'll get a bit more specific for you. But the basic stages are that you need to prove your existing concept. So what does your restaurant look like today? What stage is it? Is it simply on paper, or have you actually got something open? How successful is it? If it is open, have you got standard processes that you can roll onto the next site so that any potential investor can see that you're ready to scale? Strategic planning for your capital raise. What are you thinking? You're thinking that you want to open 2 more sites? Do you want to open 5 more sites? What is it that you've got in mind? What is your strategy? And then the valuation of your business, the financial modeling, and the investor materials that Dimitri is going to go into quite a lot of detail about later on. So what we've done is we've tried to come up with just an idea of this one restaurant that we've invented called Cafe Caroline. Cafe Caroline is a neighborhood restaurant and it's successful. You can see that it's taking 2 million a year or 40,000 a week. It's got really good costs of sales, about 25%. The labor cost is 30, 35. It's not the lowest, but it's pretty good. Prime cost margins, that puts it at 55 to 65. The rent is at around 10%, the EBITDA 15 to 20. Now, if you've got that sort of background of your restaurant and you're thinking, well, I've opened the first one, this is what I've got, you can take that to somebody like Dimitri and he could do something with this. And there's that, but if it's much lower than that, then we need to have a talk about why the margins aren't quite working. But this is a really good centered, it's, you know, as I said, not the best, but certainly not the worst. Next slide.
Thank you, Simon. So what we really work on providing this value to our clients is not just focusing on the numbers of your concept, but really providing a holistic plan of the whole business plan of your concept, especially as you start looking at locations number 2, number 3, and number 4. So over here in the dark purple boxes, we focused on some financial or operational metrics. And in the orange, we're focusing on some qualitative metrics that we like to focus on in our pitch decks, amongst others. So really, what we like to advise customers in doing before they look at expanding is to hit certain benchmarks or things that we find are items that investors really want to see in pitch deck materials. So we need customer loyalty. So POS systems, reservation systems these days really can provide good outputs in understanding how much of your customers are returning every year. So we have often a recurring customer and then a new customer reports that we can provide in weekly analytics, monthly reports, or quarterly reports. Everything we do at Paperchase is to try benchmark our clients so that we can understand, you know, looking at Cafe Caroline at a certain square footage, you know, we still want that to be about 1,000 to 1,500 sales per square feet a year, so that we know that the occupancy and utilization of the seat count and the square footage is being utilized effectively to hit these EBITDA numbers. Low rent cost is also a very important metric that investors like to see, because in downturns of sales, that's going to be the one fixed overhead that's going to put a lot of pressure on your business. You might have to increase prices where you don't have to, and you may not be able to pay your staff as much as you'd like to. So a low rent cost really provides value enhancement across your menu, allows you to pay your staff more, so more talented general managers, more talented chefs, and a better overall value proposition to investors. Project cost. So project cost, again, we benchmark across our client base. Obviously, there are going to be different ranges of design and quality of the materials that you use in your location, but really 500 to 750 square feet is a good range to provide a low enough sources and uses budget so that a payback period to investors makes sense. We really like to advise on payback periods between 3 to 5 years at the minimum. If you have a low project cost and you're very savvy with stretching a budget, of course, investors are going to like that the most. So looking at some qualitative features, and we will show some samples later on of Cafe Caroline. But what we try to focus on is, of course, not just the numbers. So we want to focus on the management team and the track record. we believe that that's probably the most important selling point when pitching an expansion of your second or third location, as that's really the most bankable asset that investors are going to pay attention to. So you want to make sure that, you know, your career is well represented in a pitch deck. So we will include very nice timelines, logos of your past experience, any awards that you may have received. We can help with copywriting for your bio, and also really put the branding and the concept to life with effective visuals. The Goldilocks space is an interesting, alignment with the project cost. So if there's anything special about the location that really fits the brand and the concept, we'll have a location section in the deck that really provides investors, particularly some real estate investors who know about the commercial retail space, what makes the space an effective location for your second location expansion. Finally, we focus on press articles, social media, anything that provides extra color to your concept that investors are going to want to pay attention to. They can also basically get more credibility about your brand when they are speaking to other people, something that can, again, benchmark your brand to other things that they have seen in the market. If you don't mind moving on, then I'll let Simon speak to considering the second location with his first-hand experience in growing some of his concepts.
Yeah, thanks. So when you're thinking about your second site, there's a lot of things to think about. So one of them is, you know, what is your current turnover? That's kind of all you've got to go on. So if your current turnover, as with Cafe Caroline, is $40,000 a week, then let's say we're aiming at something similar. So that gives us a really good, I suppose, a good aim, something to aim at in terms of the rent. Is your concept replicable? Can you do exactly the same thing in the second one, or are you going to do something else? I personally tend to think you should try to be as replicable as possible. Maybe 80% of your menu is the same, so that you're very obvious. It's very obvious that you've come from, you know, that if it's still going to be called Cafe Caroline, that actually the second one is very similar. There might be some local neighborhood changes, but basically it's similar. Does the actual building allow you the operational scope that you need, so that let's say it's one floor as opposed to 3 floors? Can you actually kind of run on a skeleton crew if, let's say, Monday nights are really quiet? What's the proximity to the current site? This is your second site, so you haven't had a chance to build up a big management team. You haven't got, you know, lots of people just hanging around. So it might be you that needs to run between the two if somebody doesn't turn up. How close is the second one to the first? And we've said here, avoid difficult construction. In a way, you should think about this as just all sorts of difficulties. Difficulties with construction, difficulties with local authorities who might have issues with pavement license, you know, just certain issues that might be specific to that site. If you can avoid it, avoid it. It might be that the site's already got some, you know, some history as a restaurant, and you can buy some of that history, as in it's still got some of the kitchen fit out and so on and so on. So that will help to make your construction a bit more predictable. So what we're looking at here is we're looking at how do you systemize your business? So what we wanted, if you've opened your first restaurant and you're planning on scaling, not everybody does. It's okay to have one restaurant. There's nothing wrong with that. But if you are thinking of scaling, then you do what I always used to call McDonald's for nice people. So what's great about McDonald's is how they've been able to scale. They've got 30 or 40,000 restaurants, and they're all pretty much the same. And they turn out what they plan on turning out. Now that comes from systems. So all of the and a lot of the things that we're putting in here are things that Dimitri can then talk about in the deck. So looking at your employee turnover, looking at your staff satisfaction metrics, looking at your standard operating procedures for both back of house and front of house, the restaurant manual that shows how you got systematic steps in place to make sure to ensure the customer experience, ensuring that you got the right tech stack. The tech stack is really important. Did you get the tech stack right in the first one? Can you now repeat it as the group scales? So have you got the same point of sale system? Have you got the same stock control system? So can you show metrics right across the group that an investor can really start to understand? And we would say this, hopefully we are already your accountants, but you want to be able to show that your books are clean and everything makes sense. You've got a really good, strong finance team, hopefully paper chase behind you.
Okay, moving on to the strategic planning section of our presentation, and really the timeline and the growth trajectory that most small concepts face, and the different types of capital along the way. So looking at phase number one over here, raising funds one by one. Some clients on the call today may have already even gone over this with us, but really what we do is create a prototype model. So all the slides earlier show the fundamental metrics if you have a historical site that we would want to see as we build out a prototype. So even if you had a new location, we would work towards a feasibility study to get you near around those metrics. That 15 to 20% EBITDA is the goal. Raising funds one by one really allows you to not have to raise a lot of capital for multiple locations where you're going to have to give up a large chunk of equity early on. So we advise clients to raise from family and friends or angel investors in a step one, step two structure. Again, I'll show a tangible example shortly. But what that means at a high level is in step one, you're going to be paying back investors ahead of yourself at a pretty accelerated rate, probably about 80 to 90% of distributable cash flow. And then once investors have received their money back, then step two will flip the distributable cash flow to investors, either at a slightly lower rate than yourself as the founder, or it could be at 50-50 as well. This provides investors with risk mitigation so that as your restaurant achieves stabilization and effective free cash flow profitability, so not just P&L profitability, but actually building that bank balance up so that they can actually see a return on their investment. This allows you to get from location number 2, 3, and 4, where you're starting to hit a free cash flow that is self-funded. So once you're at that step 2 phase and you're putting cash back into the hospitality group as a whole, your bank balance is growing enough so that you actually have the decision of opening that 5th or 6th location yourself without any help from anyone. That allows you to have a lot more leverage when you're approaching a bank or growth capital investors. So it's a really great place to be where you're not as reliant on outside capital, but now you want to take your business to the next phase. So to get to 5 to 10 locations, you are going to need that CapEx injection, since we are such a brick and mortar heavy industry. And debt is often a metric that we like to, a vehicle that we like to make sure that investors understand it could be the best solution they have, because they don't want to give up as much equity. And we will help with our consolidated model show our clients how much debt they can support, what kind of ratios they can support. And then we'll show the scenario against growth equity capital and what that dilution looks like. it often comes with its own set of pressures, having growth capital early on. So if you can, either SBA or debt financing may be an attractive step in phase 3. Finally, then we get to phase 4, which is the more professional investor scaling to 5 to 10 locations and beyond. Or it could also be a liquidity event at an exit where you may need some M&A advisory to make sure that you can optimize the valuation of your business. Is it the right time to do it? Perhaps the market, as it is now, with interest rates so high, valuations have generally come down slightly, particularly in the private markets. So, having an advisor by your side, particularly to model out your business in a multitude of scenarios, is really important in the strategic planning phase. What we like to also mention to our clients again is the distinction between the P&L and the cash flow statement, particularly across all these phases of growth. Our models are preset with a lot of detail from EBITDA down to free cash flow. What effect existing equipment financing or existing loans you may have taken along the way, investor distributions again. So as you are going through raising funds one by one, what is that equity distribution waterfall going to look like? We have industry grade models that investors will feel comfortable seeing in due diligence. So having us alongside you all the way through to scaling to that private equity discussion is really useful. Okay, now we'll move to some more tangible examples so that you get an idea of the actual steps that we help our clients with. So we prefer to advise our clients to create a hospitality group, which is essentially a holding company as you raise your dollars for a single location. I'm just going to switch to a tangible example here of our prototype model. Okay, so this is our paper chase individual model, which is stress tested across a multitude of investors in the industry and is a very best practice tool to look at everything that you could really think of when you are underwriting a single location. We have a very easy to follow table of contents where we look at the introduction type of details and sources and uses that you will need to assess along the way. And then we have a very detailed project cost, as we mentioned earlier, section, where you can really budget out your concept in detail across about 8 different sections. Looking at the intro details of Cafe Caroline, we put in the type of concept, the industry subsector, the size of the restaurant, what is our timeline, what is the budget that we are looking at, and often we can work with the client to understand what this budget should be. We have a detailed real estate information section. So we put in, if you do have the space in mind already, or we can help with lease comps along the way as well. Focusing again on that structure for investors, particularly in America, as you're raising for the first to 4 locations, you can look to create a structure similar to this. So we have a first split with a preferred return, 90% to your investor base. And then once you hit the second hurdle, then we have a different split. So it could be 40% to your investor base and 60% to yourself. Again, over here, we illustrate it. And then we have a waterfall built into our model that clearly shows investors when they're going to receive their money back and at what IRR and cash multiple they'll receive their money back. Another feature our clients love is our one-pager. So here we have almost like a tear sheet or a fact sheet that shows all the high-level metrics during ramp-up, stabilization, and key investor metrics as well that are easy to benchmark to other concepts. So here we have our project cost per square feet, per seat. We have our equity capital. We have our basic sales separations in terms of food sales, beverage, the day parts, and then we have some stats across our sales, free cash flow, return on equity, and return on cost. Finally, we have some equity assumptions. So if we had a long hold period, we can show our investor IRR and cash multiple. Moving on to our project summary, and again, another feature our clients love, and how our accounting team can track certain design changes, controllable changes, to really keep the vendors in check as you start spending money onto your project. This is a very useful tool to, again, show investors as well further down the road as you're getting close to opening, what really went on with your CapEx budget and your pre-opening budget. Finally, we have a dashboard that helps summarize everything, again, in a very easy and visual format. We have our gross sales budget. We generally always try model quite conservatively for our clients, just so that there are no overselling or overpromising to investors. We like to have accurate feasibility studies that really are still marketable, but realistic. Most importantly here, as we've mentioned, we focus on cash flow primarily at Paperchase, not just EBITDA. So we want to make sure we understand the project payback, IRR, and cash multiple. Next, I'll move on to how we present our pitch decks to our clients. So just give me 1 second. So now, again, looking at Cafe Caroline, we have created a very simple investment memo. We always create a very simple table of contents with an executive summary highlighting the brand, very easy to read, best practice presentation materials here. And we start outlining straight away the investment highlights of the project. So here we have, how much equity are we going to need? What is the project cost per square feet? IRR, cash multiple, the year one sales, and what is our stabilized EBITDA? So again, this is pretty industry standard to show investors straight away, what am I going to get out of this project? Focusing again on sources and uses, this links to our prototype model. So we have everything that an investor would need to see. Okay, what am I investing into? What is their project cost going to be? What type of contingencies and pre-opening expenses do they have? This is an area where we really stress to clients that it's important to think about how long are they going to be training their staff? How much inventory do they need to have a successful opening? We want to make sure that we are budgeting the project correctly and we don't have to keep asking investors for money once we open. Our pro forma highlights. So again, here we have a clear link to what we just went through in the Excel file. This gives investors a very clean view of what metrics they expect to achieve before digging into a due diligence item. As mentioned before, we also work on the brand overview. So if we look at some press and buzz, we will first request some media and preferences that you'd like to share. And then we'll also do our own research about your brand and your concept. And then we will start adding color to your pitch deck to make sure that we are showing your business in the best light. Next, we have some social media and reviews. We didn't create an Instagram for Cafe Caroline just yet, but here we just have some examples on how we could potentially show a little more color to the brand. Finally, we would always have a team section where we would showcase Caroline as a chef, a little bit about her, where she has worked, what makes her reputable and capable of opening up another location and scaling her vision. We'll include relevant logos and brand awards just so that we are showing a clean professional deck to potential investors. Caroline, if you don't mind resharing the presentation. Thank you. So switching back to when we are raising that dollars for your single site, we've just gone over how we would create the materials, but it's also important to note that we will help you guide your strategy to who should you go out to. So family and friends is often the most common route we find at this stage. They may take on convertible loans, or they might use the structure that we just showed in the step 1 to step 2 payback. And then there's also angel investors or hospitality groups that may start, especially if you have a very good track record and career, they may back you as well early on, particularly with a good oversight and financial oversight by your side. What we really focus on at Paperchase is starting to mitigate risk for the restaurant industry and for early stage clients. So having Paperchase by your side just provides that transparency to investors to create either monthly or quarterly reports. This would be under our FP&A or CFO services. And this is really industry standard across the board. So they're going to want to see where their money's going to, what's their expected distributable cash coming in the next quarter, the next 12 months, so that they can also plan their investments more strategically. Another item that's point number 3 here is before expanding to number 2, you want to make sure you have a cash cushion on hand, which is really going to be about 6 months of overhead, where you want to make sure that you are not putting too much pressure on yourself as you open that second location. Your work's often going to basically double because you have to manage your current staff, you have to hire new staff, or you have to allocate your talented team members to help train your new staff. So it's important to go into your second location feeling confident that you have the financial foothold to make it a success. Next, we'll move on to the more exciting phase for our clients and founders that have reached a stabilized model where they now have about 4 locations. They do have cash reserves, and they are looking to expand 5 locations to 10 or even further. This is where now you've proven a multi-unit concept, and you're looking at, again, like we mentioned earlier, debt financing to maybe get you to that 10 location, or equity financing to help you scale even further. This is where you are going to start diluting yourself if you have taking money from growth equity capital, and you generally have to plan on giving 10 to 20% equity, perhaps even higher, depending on the state of your balance sheet and your business as a whole. This is where we start moving our clients to the consolidated model, where we're adding up all your locations. We're showing you your balance sheet and cash flow statement every month or every quarter with a board presentation. And we're showing you the scenarios that you'd be having to go through to achieve certain debt financing, or to provide enough opportunity to investors to invest into your brand. This is where we'll help with valuation as well, so that you understand if you're willing to give away 20% equity, investors are going to expect a certain valuation for that 20% that is reasonable. And that's where our underwriting and our valuation work is really useful to our clients. And now finally, to conclude, is really, these are industry grade materials that you need during planning a fundraise, planning a potential exit, or even just doing some strategic planning in-house. And this is industry standard across the restaurant industry. And we've really worked on creating standardized work for our clients across the prototype financial model, which I have shown, the consolidated model, which will add up all your locations, and then the pitch deck, which will present the business either at individual level, or we'll also do a confidential investment memo, a SIM deck, to really show all your locations and really value your business for that investor round. We use absolute best practices across the industry. So in the prototype financial model, as you saw, we really work on the level of detail down to the last hour, whether that's breakfast, lunch, or dinner. We have seasonality factored in for certain revenue centers you may have. So if you have a patio, a VIP section, if you have a ramp up during opening, we really model everything down to the last underwritable input that we can. That again is linked to a deck that we can create for you, but it also has a PDF function. So we can, if you don't want to have a deck and you just want to plan for your second location, that's also possible, where it also turns into a PDF document, and you can decide to do a pitch deck later. A consolidated model, in a nutshell, as I'll just reiterate, is a P&L, a balance sheet, a cash flow statement, and a whole lot of dashboards, graphs, visuals that show trends, show variance analysis across your concept, across your locations, across your comp group. So often as you're starting to hit 5 to 7 locations, you're going to want to show your same store sales and your comp level metrics to investors, and having that done by a financial advisor like Paperchase just makes you feel confident that you have done all those calculations the right way. The pitch deck, as you've seen, can be scaled up or down. We've done about 30 pitch decks for our clients already this year. And we've really built out that process to customize it to your brand, to your vision. We go over it with clients quite robustly, where we get feedback on slides. We present and reiterate as much as possible to leave our clients satisfied with the end product. And now I'll take it back to Caroline for leading our Q&A.
Thank you so much, Dimitri and Simon, for that wonderful presentation. So we've gone over kind of like the basics that you need to know about expanding your restaurant. And now we'd love to answer some questions from the audience. If you have any general questions, or if you have questions that relate specifically to your concept and with your growth, we'd love to take those in the Q&A, or you can raise your hand and I'll unmute you and you can speak directly to us. So I'll just give everybody a second. Okay, I see that we have a question. The commenter asks, what are some red flags that scare away investors when they're looking at potential investments?
Simon, did you want to take it, or do you want me to take it?
Yeah. So I'll give you a few that I think of. So one I mentioned earlier is about scalability, and there are a lot of all of us restaurateurs, we're dreamers, and we love to open different things. We love to be creative. So you've got 3 restaurants and they're all completely different. You're not showing an investor that you can scale. So you really have to think about what you want. There's nothing wrong with having 3 completely different restaurant concepts, but you're really going to have to think about 3 different fundraisers, because unless behind the scenes there's something that's really showing that actually that one's chicken, the other's burgers, but actually the systems are all very, very similar, there's nothing for an investor to really see, and there's nothing for someone like Dimitri to show data on. So that's one thing. Another thing, of course, is if the first one doesn't work, very hard to raise the money for number 2 and number 3, because that's what they're going to be basing the decision on. So these are a couple of red flags. There's lots more. Sometimes you get just a restaurant operator who isn't in it for the money. They're just they're overstaffed. They're too generous. Lots of things that, there's bad reviews online. There's all those things as well. So it's just fraught with it's fraught with red flags. There's a lot of red flags.
Awesome. Thank you, Simon. We have a question. Can you speak to what valuations you anticipate in seeing in the next 6 to 12 months for a 5+ location concept? What are some different ways of looking at this in the context of a growth equity investment?
Yeah, I can take this question. So right now we are seeing very high valuations for the fast casual concept in the market, as most of you may be aware. And we do have a Q2 research newsletter coming up, but we have January, February, and March up on our website if you wanted to take a look at some public comps materials. But really, there's two key metrics in the restaurant industry when you are at the 5 location growth phase, and that's multiple of revenue and multiple of EBITDA. And the multiple of EBITDA that you'd likely have at about a 15 to 20% EBITDA margin could range between 5 up to 10, depending on how strong your sales per square feet is as well, and how replicatable your concept is. So the quicker you can open up locations, the higher your valuation is going to be, and the more attractive that's going to be to growth equity investors. But looking at some standard multiples of revenue, particularly in the franchisor segment, those are going to be much higher. If you're company owned, of course, that might be slightly lower multiples to revenue and EBITDA. But generally, looking at a 5 to 10 location concept, you're probably looking at EBITDA multiples around the 8x stage. Depends again how much equity you're willing to give up for us to back into that valuation, just to show you what an investor is going to expect at that stage. A revenue multiple could be from 1.5 to 2.5x as well. So again, that's where we help with the consolidated model to understand what your valuation is going to be in a discounted cash flow basis. So we'll take your growth plan, discount it back to today, put in the capital infusion you would need to open all of those locations, and then help you understand what an investor is going to expect.
Thank you so much for your question. Any other questions from the audience? Happy to answer anything that you have, whether or not it relates specifically to this topic. But yeah, please don't be shy.
While you're all thinking, can I just add something in to what Dimitri was just saying? So Dimitri tried to answer that question along, what kind of multiples are there? And of course, multiples are going to be based on, pretty standard metrics like turnover and EBITDA. But he also mentioned that an investor will look at other things like what speed can you open at? And one of the things I always tend to look at is how robust is the concept. And there's a lot of figures that feed into that, what makes a concept robust. And one of them is that how low could you take your staffing level on a quiet Monday lunch, say? So if you think about it like a pizza restaurant, that actually it's really quiet on a Monday lunch. So there's one guy in the kitchen and there's one guy in the front. And, when the 10 people who came in for pizzas disappear at the end of lunch, one of those guys washes the plates. And that's how low you can go. Now, that's really encouraging for an investor who knows that some of these sites are going to be rammed day and night. But what happens if one of them's not? Well, if it's not, we know how to get the cost down to a minimum. Now, not every concept can do that. If you've got a really complicated kitchen, you just can't get it any lower. But if you've got the kind of menu, the kind of food offer that allows you that, then that's what we term robust. That it can go really high, but it can also go really low.
Great ad, Simon. We have a question. Do you anticipate a change in interest rates to affect investor demand for fast casual investments? Also, any advice on what family offices find attractive about an investment in particular? Great question.
Yeah, so interest rates at the moment have really been high for about almost a year and a half now, and almost across all sectors, valuations have come down, particularly in restaurants as well. We actually have, I'll pull up a chart now that clearly shows this. Just give me 1 second. So over here, you'll actually see enterprise value multiples with revenue. And then we have the 10-year treasury interest rate in the blue line over here. So here you can see how as interest rates went up, the dark blue line has really receded in terms of valuation. So enterprise over revenue and enterprise value over EBITDA has gone relatively down into Q2 2024. So we're not interest rate forecast analysts, but we do assume that this is kind of the new normal when we underwrite. So we advise clients to be wary that if interest rates do not come down, number one, they need to have accurate planning so that they make sure that they can withstand debt covenants when they're lending from banks. And number two, to really not hope that interest rates will come down and then increase their valuations. They may come down. It is an election year. So there might be some political will to reduce the 10-year treasury. But at the moment, we like to advise clients just to look at comparable public companies to themselves. And then we discount those multiples to private market multiples, or we use private market data for any transactions that we have an understanding of what a revenue or EBITDA multiple was. So if interest rates go down, your valuations are going to go up. If interest rates go up or stay the same, then the underlying performance of the business and its profitability needs to basically find this new normal and carry on producing higher growth, better operating metrics in terms of EBITDA and cash management. Any advice on what family offices find it attractive about an investment in particular? So family offices, depending on the type of family office, they will be pretty similar investors to growth equity capital, where they will prefer to maybe have that longer time horizon, but at the end of the day, they are still focused on getting a sizable equity piece in your business to provide a return to their portfolio. So they will often be looking for similar equity stakes as a growth equity investor. There may be more higher net worth people related to family offices that may come earlier in the round compared to growth equity. So if you do have personal connections or contacts at family offices, they might come in earlier at location 3 to 5, maybe before you've truly scaled a multi-unit concept. That's maybe the one separation there. But they are going to find the same attractiveness into your concept as a professional investor would. They want strong prototype metrics. They want you to understand your pathway to scalability. So they're going to be a very similar style of investor.
Thank you for your question. Simon and Dimitri, are there any common mistakes that you see entrepreneurs make when they are scaling or seeking investment?
I can take it, but I think
sorry, you broke up a little. I've got a bad connection. Did you just say?
I asked, are there any common mistakes that you see entrepreneurs make when they're scaling or seeking investment?
Yeah. I think that it's very easy for a restaurateur to just be a little bit too kind of inward looking and not outward looking. You're not doing it for yourself, you're doing it for your customer. And you need to have a concept that people actually want to buy. Restaurants are retail. So when you open that store, you've got to have things that people want to buy and that you can reproduce day in, day out. And so often I see somebody who thinks, I'm really sick of doing this boring job I've been doing. I want to open a restaurant. But it's hard. And for people like us, it's relatively easy because we love it. But the work is hard. And you've got, once that place is open, it's got to be open, probably 7 days a week, 14 shifts a week. And, so what mistakes do people make? The mistakes are usually that they don't really think it through.
I'll add to that as well, Caroline, but really it's what I mentioned earlier is the movement from the P&L to the cash flow statement and then the forward-looking plan. So that's where we help really show that full picture to free cash flow generation. So, you may have a great month on your P&L, but you had some CapEx reserves that you needed to tap into. You have consistent equipment financing loans that we see sometimes clients that we sign on that have them before we go over it with them that need to understand the debt service that they need to pay for every month. Also, if they have lingering accounts payable that are sitting on the balance sheet that they just need to clean up, that's again a working capital item that's not on the P&L. So having that cadence, and often at the earliest stage, a quarterly cadence is fine. But as you're opening new locations, you're going to have a lot of cash flow items that may be not so clearly shown on the P&L. And that's where our consolidated model helps prepare restaurateurs to understand exactly what they need to make sure they understand before they want to scale.
Thanks. We've got a question. How many years of growth should a Series A ideally fund prior to a planned bigger Series B fundraise?
Can I take this before
Dimitri
gives the real financial answer? And that is that the first question is, how many restaurants have you got when you get to Series A and then go on to Series B? Have you got one restaurant? Have you got 5 restaurants? And the reason I say that is because something that Dimitri and I have discussed often is the cost of equity. Now, when you've got one restaurant, it feels like equity is really cheap. So you give away that equity that hopefully is going to get the money to open another restaurant. But that's about the most expensive thing, particular case. When you say how many years of growth should Series A fund, if you've got 2 restaurants and you're trying to get to the third, and at the third you start to become self-funding, then actually you don't need that Series B fundraise, possibly. Unless you're, as in that model that Dimitri showed you earlier, that once you get through stage 3 and onto stage 4, that you think that you're ready to properly scale and you really want to go fast and big. Well, that's a slightly different thing. But a lot of restaurant businesses don't do that and don't need to. You get to 6 restaurants or so, you're self-funding, you've got a really nice life, and that's as far as you want to go. So behind this question of Series A and Series B is to really think about what kind of a business is this and how many individual restaurants has it got and what does it want to become?
Great. In terms of just some templated metrics for these 2 rounds of financing in the venture capital world, but the Series A is normally about 5 to 10 million, and that should last you, relatively about 3 to 5 years as you expand your location count. And then your Series B might be, that type of private equity, consumer product, private equity company that wants to take you anywhere between 5 to 10 years. Remember, they have to realize a return on their investment as well. And their time horizons are often between 5 to 7 years. So they either want to keep growing with a new investor where they can create a liquidity event for themselves. you'll also participate in that. But then, as Simon mentioned, this is where it helps to have that cap table in front of you so that you understand, are you getting a fair valuation, and are you happy with the dilution that you're going to encounter? At Series A, it probably will be 10 to 20%, depending how hot your concept is. If you have a lot of demand, you can give away 10% with that Series A investor, maybe then participating in your Series B, or you may have to give away a larger amount if you want to scale faster without maybe the metrics that you would have hoped for. So again, Series A, to answer your question, 3 to 5 years. And then, yeah, the Series B fundraise can be anywhere between 5 to 10.
Thank you so much for that question. With that, I think we're going to wrap it up. I will email everybody a recording of the webinar after this. Probably tomorrow morning you'll get it. And in that email, I will also copy in Dimitri and Simon. So if you have any questions that you want to ask them, or if you want to just meet with them to get some advice, pick their brain, or even learn more about how we can help you expand your restaurant, you can go ahead and just respond to that email and we'll get you guys connected. I really, really appreciate everybody for taking the time today out of their busy day to join us. And I hope that we'll see you for our next session. Thank you.